Welcome to Module 5 of our complete English masterclass on capital markets and securities. We have covered bond foundations, pricing, government bonds, and inflation-linked bonds. Now we go deeper into the mathematics of bond price sensitivity. Over the next 6 episodes we will build a precise understanding of how much a bond's price moves when its yield changes. The tools we will master, Macaulay duration, modified duration, and convexity, are the fundamental risk metrics of every fixed income portfolio in the world. Today we set the stage by examining the basic problem. The bond pricing formula gives us price as a function of yield, but it does not directly tell us how sensitive that price is to small yield movements. We need a measure of slope, a measure of curvature, and a way to translate yield surprises into expected price moves. By the end of this episode you will understand precisely what we are trying to measure and why it matters so much for fixed income risk management. Section 1. The problem stated. Imagine you hold a bond worth $10 million. The market yield on similar bonds rises by 1%. How much money have you just lost? The bond pricing formula gives the answer, but only by recomputing the price at the new yield and subtracting from the old price. That works for one bond but becomes impractical for a portfolio of hundreds or thousands of bonds. We need a faster, simpler approximation. We need a single number, a sensitivity coefficient, that tells us approximately how much the bond's price will change for a given small change in yield. This sensitivity coefficient is what duration measures. It is the slope of the price-yield curve at the current operating point. And it is the single most important risk metric in fixed income. Section 2. The price-yield curve, what it looks like. We mentioned the price-yield curve briefly in earlier episodes. Let us examine it more carefully. The horizontal axis is yield. The vertical axis is price. For any given bond, the price-yield curve is downward sloping and convex. Downward sloping means higher yields produce lower prices, the inverse relationship we have established many times. Convex means the curve bends inward, like a bowl from above. The convexity means the slope of the curve is itself changing as you move along it. At very low yields the slope is steep. At very high yields the slope is shallower. The price-yield curve is not a straight line, and that fact is the entire reason we need both duration and convexity. Section 3. Why slope matters more than absolute price. Most investors think about bond prices in absolute terms. They look at the current price and the absolute change. But for risk management, what matters is the slope of the price-yield curve at the current operating point. A bond that has a steep price-yield slope is highly sensitive. Even a small yield change produces a large price change. A bond with a shallow slope is less sensitive. The slope is what tells you about risk. Two bonds at the same current price can have completely different price-yield slopes and therefore completely different risk profiles. For portfolio managers, knowing the slope of every holding is essential. The total portfolio slope is the sum of individual bond slopes weighted by their market values, and that aggregate slope is the portfolio's primary risk measure. Section 4. The local linear approximation. Calculus gives us a clean way to think about slope. For any smooth curve, we can approximate the curve near a point by its tangent line. The tangent line at a point is determined by the function's slope at that point. The approximation is good for small movements along the curve. For a bond, this means we can approximate the actual price-yield curve near the current yield by its tangent line. The slope of that tangent line is the bond's derivative with respect to yield, dP over dysprosium. This derivative, with a normalization that we will see in the next 2 episodes, becomes duration. The local linear approximation works well for small yield changes. For large yield changes it becomes increasingly inaccurate, which is the entire reason we need convexity. Section 5. The dollar duration concept. Before we formalize Macaulay or modified duration, let us define the simplest sensitivity measure, dollar duration. Dollar duration is simply minus the derivative of price with respect to yield. The minus sign is there because price and yield move in opposite directions, so dollar duration is naturally positive. If a 1 basis point yield rise causes a $1,000 price drop, the bond's dollar duration is approximately $100,000 per percentage point. This number is useful for risk reports because it directly tells you how much money you stand to lose for any given yield move. Dollar duration in the bond market is also called DV01, dollar value of 1 basis point. A trader watching real-time bond market moves often thinks in terms of DV01, because it directly converts yield changes into dollar profit or loss. Section 6. Why a single duration number is so useful. The reason duration is such a useful concept is that a single number captures a bond's primary risk exposure. Yield is, of course, only one risk dimension. There are credit spreads, there are call risks, there are tax risks. But yield risk dominates for most government bonds, and yield risk is a major component for corporate bonds too. So one number, the duration, gives you a useful first-order summary of risk. A portfolio of bonds can be summarized by its aggregate weighted average duration. A bank's interest rate exposure can be summarized by the duration mismatch between its assets and liabilities. A pension fund's hedging strategy can be expressed as targeting a specific aggregate duration. The reduction of complex multi-bond positions to a single duration number is what makes practical fixed income risk management possible. Section 7. Different durations for different purposes. There is one subtlety worth noting up front. There is no single thing called duration. There are several related concepts. Macaulay duration is a weighted average of cash flow times, measured in years. Modified duration is the percentage price change per percentage yield change, also measured in years. Dollar duration is the absolute price change per yield change, measured in dollars. Effective duration is a numerical sensitivity calculation that works for bonds with embedded options. Each of these is appropriate for a different purpose. Macaulay duration is intuitive for asset-liability matching. Modified duration is useful for percentage price change estimates. Dollar duration is useful for real-time risk reports. Effective duration is useful for callable or putable bonds. We will cover the first three rigorously in this module. Effective duration is a more advanced topic that comes up in option-related modules. Section 8. The roadmap for Module 5. Let us preview what is coming. In Episode 2 we derive Macaulay duration as the weighted average time of a bond's cash flows. The weights are the present values of each cash flow divided by the bond's total price. The intuition is that a bond's economic maturity is not just its stated maturity but the weighted average of all its cash flow times, with more weight on earlier cash flows because they have higher present values relative to face. In Episode 3 we modify Macaulay duration to get modified duration, which directly predicts the percentage price change for a small yield change. In Episode 4 we use modified duration as a working rule of thumb in portfolio management. In Episode 5 we add convexity, the second-order correction that captures the curvature of the price-yield relationship. In Episode 6 we close with immunization, the use of duration to hedge interest rate risk in pension funds and insurance companies. Module 5 takes you from a working knowledge of bond pricing to a working knowledge of bond risk. Conclusion. Bond pricing tells you the price at a given yield. Bond risk tells you how much that price moves when the yield changes. We need a sensitivity measure, a slope, to convert yield surprises into expected price changes. The price-yield curve is downward sloping and convex. We can approximate it locally by its tangent line, whose slope is the bond's derivative with respect to yield. This is the foundation of duration. Dollar duration is the most direct measure. Modified duration normalizes by price. Macaulay duration interprets sensitivity as a weighted average time. And convexity captures the curvature that duration alone misses. In Episode 2 of Module 5 we derive Macaulay duration from first principles and work through a concrete numerical example. If you found this episode useful, please share it and subscribe to Capital Markets and Securities with Michael for the full 48-episode course.